Good afternoon, everybody. I'd like to welcome you all to the Halftime Talk weekly feature interview. I'm delighted to be joined today by Dr. Anas Al-Hajji, Managing Partner of Energy Outlook Advisors. Dr. Anas, it's great to have you with us again.
Good evening to you. Thank you.
Great to have you with us. Well, as we do on this feature interview, we invite our guests and analysts and experts to give us their take on everything energy. And we're delighted to have you, halfway through this very dynamic year, to say the least, on all fronts, geopolitically, and of course on the energy front, impacted by that. So, looking forward to having your take on what you think has happened in the first half of 2023. Do you think it has defied expectations from an energy demand point of view, or has everything gone according to what we were seeing in January?
Thank you very much for inviting me today. In the previous interview that we had 6 months ago with Sean, we discussed the outlook for 2023. And at that time, we published our own outlook, by the way, which is still available for free on the web. People can search it on EOA 2023 Oil Market Outlook. And amazingly, we were able to nail it. I mean, everything that we did talk about at that time happened. And we are very pleased to see that. Of course, at the same time, it is scary. So there were a couple of lessons that we learned from the experience of the outlook and what happened. And one of the most important lessons is that the basics, despite all the changes and all the development that we've seen in the energy markets, the basics are still the same. Sanctions do not work. When you open an economy after lockdown, it takes time to recover. The idea that it recovers the second day is complete nonsense. And now we see it before our eyes. So there were two major reminders that sanctions do not work. And when you open an economy, it takes time to recover. And we did cover that. And that kind of made our forecast of demand and prices lower than everyone else, of course, except one bank. But beside that, everything was spot on.
Okay, Dr. Anas, let me ask you, within that forecast that you made and what you put into it, how much of a factor was Fed policy and what's happened on interest rates plugged into your forecast? How much impact do you think it has had on, for example, Chinese demand?
Well, it's not necessarily on Chinese demand as much as on the others, because China's demand is really related to the opening and the recovery. But the Fed policy really wreaked havoc on the world economy, especially for developing countries that has floating currencies. The increase in the value of the dollar, and as everyone knows, oil is priced in US dollar. So even if oil prices stayed flat, the rise in the US dollar made oil more expensive for those countries. Those countries that suffered already from global inflation, especially when it comes to food and food-related and agricultural stuff, because of the war in Ukraine. So there was no money left. If you want to eat, then you have no money left for oil. So the demand for after the recovery from COVID, the demand should be stronger. But because of the Fed policy and the stronger dollar, it limited that growth. So yes, it has an impact.
Well, what about, let's look forward now. We've touched on the impact of the last 6 months. What about the next 6 months in terms of both likely Fed policy and continued impact, as you said, on the US dollar, emerging economies, and also on elements like, Chinese exports to those economies that are being impacted? Do you see a more positive growth scenario in the second half of the year?
For us, basically, the title of our outlook was The Tale of Two Halves. 2023 is the tale of two halves, which means that we have a weak recovery weak demand, weak prices in the first half of 2023, and a completely the opposite picture on the other side, where we have stronger demand in the second half with better oil prices or relatively higher oil prices. And that's when we try to update our outlook in the last 2 weeks, we found out that the changes to the original view are very limited. There are some tweaking that we've done, but that's it. The view is still intact that the second half is going to be better than the first half. We are going to see a pickup in oil demand unless we have like a major global recession. But the issue here that we got to pay attention to, there are kind of multiple issues that we have to consider. One of the surprises we got in the first half was an increase in gasoline demand in most of the European countries, which was a surprise because we have a major penetration of electric vehicles, and then you have increase in demand at a time when everyone was scared to death that high oil prices are going to destroy the economies of those countries. Well, one of the explanations could be that those countries, or many of them, decided to give fuel subsidies to their own populations, which is by any standard, even from energy security point of view, was a big mistake. But that subsidy increased the fuel consumption. So we have an increase in demand. Now, many of those countries basically are ending those programs. And we got to see what is the impact on gasoline consumption and diesel consumption in Europe as they end those subsidies in the second half. And would that reduce the demand meaningfully or not? On the other side, we have a major issue that it really needs to be the center of attention right now of every energy conference. Energy data deteriorated significantly in the last 2 years. And the deterioration continued. And when you have deterioration in the data, even analysts with long-term experience cannot figure it out. It's very tough to deal with the energy markets without the data or without accurate data. And what made the situation worse are the media and the journalists who are competing basically to provide the breaking news on Twitter, while the data itself is not reliable. And that's why we've seen...
You're referring to data on Russian oil flows, supposedly, because of the change of direction, and China releasing data. Which data in particular?
Let me start from the beginning. One of the main problems we have, as you know, that here in the United States, the EIA publishes this weekly data, and we have what we call the adjustment factor, which is the difference. It's a number. Supply has to equal demand all the time, but their data shows that they are not equal, and therefore the difference have to be plugged in, and that difference got larger and larger and larger, and no one knows where that oil is and where it is. So even when you talk about the United States, we have a major data deterioration. We don't know how to solve it, although they conducted an investigation and they had recommendations, etc. And still, the data is getting worse by the hour. Then you go globally, you have most of the Russian exports basically are going dark in ghost fleets. And then every other country basically is trying to hide their imports in one way or the other from Russia or Iran or Venezuela because they don't want to deal with the Biden administration or others. So whether you are talking about the United States or others, we have a problem. Even OPEC itself depends on other companies to know its own production. That's why they publish the secondary data. And that's why we've seen Saudi Arabia basically asking the Russians for clarity on their own exports because no one knows what's going on.
Okay,
so the data...
Let me just stop you there or interrupt you and take you up on that particular point of Saudi. You mentioned OPEC. I wanted to talk to you about it. Give us your take on the latest move by Saudi of this voluntary cut, at least for July. And you mentioned Russia. So let's also get your take on its partnership with Russia within OPEC Plus. Many people are saying because Russia is too busy with its war basically OPEC Plus is redundant. Would you agree?
No, if you look at OPEC or OPEC Plus and you study the history of it since 1982 until now, there is nothing new. It's the same old stuff. It just, they perfected their game in 2021, 2022. They stopped those monthly meetings, and that's created a problem. And that's bringing me to the Saudi. The Saudi cut, in our view, and we wrote about this in details before the meeting and after the meeting. The objective of the Saudi cut is literally to control the market narrative, not because of lower demand or because they want higher prices. $75 is really good for everyone. So this is not the big deal. It's really to control the narrative. And if you look at OPEC decision, OPEC Plus, they couldn't agree to a cut for several reasons. One of them is they already cut enough to the chase, where some of the smaller countries will never agree to another cut because it just reached the bone. And they don't want to. And OPEC decisions are by consensus. So they don't want basically to show the world that they are not united. The other issue for OPEC is they got a serious problem, because if you look at OPEC as organization, not the members, if you look at OPEC as organization and you look at OPEC as a research center that produces the monthly oil report, you look at the forecast in the monthly oil report is very bullish.
Yes.
So if OPEC decides to cut as an organization, as a group, then they are throwing the research center under the bus. So either there is a problem, there is a contradiction here. So by not cutting, they are being united as a whole, as organization, and as members. But they lost the narrative since they stopped the monthly meetings. So the Saudis are saying, look, I'm going to go for a 1 million barrel a day cut in July to control the narrative. And then I'm not going to tell you what I'm going to do next, because the following month I might extend it. I might not extend it. I may cut 500, 700, whatever it is, but I am going to control the narrative.
Okay, and that's what they've said, but it's arguable whether they've been able to control the narrative to, let's say, work the shorts out of the market, because we haven't seen that reflected in prices yet. Would you say that if you had to put your finger on an average Brent price for the second half of the year, would that be above or below $80?
Well, I just want to mention one point before I answer that question. The idea here is that people are looking at the prices before the meeting and they are expecting the cut to increase prices. Well, we already written this, that if OPEC does not cut, this is bearish, and prices would decline by $4 or $5. So the Saudi cut is a counter to that. And therefore, we should look at the other side, that prices did not go to the 60s. And therefore, the cut was effective. Those who are looking at the increase, they are looking at the wrong direction.
Okay, so it's a support. Basically, it came in to support the $70, essentially.
Correct, in a sense, to create a floor. And that brings me, I will answer your question, and then I will add one more point. The question is, we expect prices to be higher than 80 in the second half. It will go up higher than 80. But here is the problem. The Saudis created a floor in the market right now with their decision to cut. And it is very clear there is a cut. I mean, we have those 10 tankers right now, 20 point something million barrels are in the in Ain al-Sukhna, just at the entrance of the Suez Canal, some of them being there for 3-4 weeks. So in a sense, they are trying to limit the exports. That's very clear. But the problem here is, as prices go up and go up above 80, China is not going to like it. And China in recent months, they built their inventories and they built their strategic petroleum reserves. And as they did in the past, they are going to use it to prevent prices from rising. So our conclusion is Saudi Arabia is going to set the floor and the Chinese are going to set the ceiling, and the range is really tight.
Okay, and in terms of Chinese, I mean, you're saying you're more bullish for the second half of the year in general for oil demand, for prices as well. Why do you think that the situation in China would improve economically, domestically, or else in terms of even how it's influenced by the rest of the world. I mean, you know, its exports are influenced by the US economy and interest rates. And many people are saying these interest rate rises that we've seen so far are only going to now start to trickle through to the US economy. And that's when we're going to see an impact from now on, i.e., Chinese exports will be impacted.
Yes, if we are going to end up with a recession or lower economic growth, that's definitely the case. That's absolutely correct. But on the other side, we have other issues we have to look at, that the Chinese government is really trying to stimulate its economy. And at the same time, those issues that we talked about earlier that takes time after recovery to recover, they are going to show that too. But to answer your question precisely, we have to specify where we are starting from, because starting that point is very important. We have a problem in the data because people expected massive growth in Chinese economy, and now it's not materializing. We did not expect that much. So our view is still intact in this case, but the others are having the problem because they have to retract their predictions. So knowing where we start from the beginning becomes important in this case. The other issue that is really becoming a problem right now, as oil prices will increase, and the Russian differentials, the Russian price differentials are shrinking, which means that as prices increase, the increase in the Russian prices are going to be way higher. And the question is, will India and China continue their purchases the same way they used to do as prices go up? And that will lead to another problem, which is a lesson we learned in 2022. And I talked about this in the previous show, that something we've seen in 2022 we never seen before, which is the degree of substitution among various energy sources that did not exist before. Let's say you are in the summer, the weather is very hot. Why is it very hot? Because the wind is not blowing. If the wind is not blowing, then you have no wind power. So what do? You resort to gas. Well, gas, you need to import LNG. LNG goes through the roof. LNG prices go through the roof. Now you cannot afford it. What do? You go back to coal. Coal prices go up. Now you go to the lower quality coal. We never seen this dynamic before, and it's happening so fast. And it's going to happen probably every summer, and it's going to happen this summer too. So what's going to happen here is probably the Chinese are getting ready because they understood this dynamic. Why? Because if they resort to coal, the level of emissions are going to go up substantially in Chinese cities. And we've seen them before. They literally shut down the electric grid in some cities for a few days to lower the emissions because it was really extremely hot. And when they do that, people resort to private generation. And what they use for private generation? Diesel and LPG, oil. So the degree of substitution and all the dynamics that I'm talking about is something new, and we really need to kind of figure it out to understand its impact and its impact on oil trade at the time when oil trade is shifting worldwide.
Absolutely. As you said, a lot of substitution going on and continuing to be dynamic on that front. One part of it, you mentioned Russian oil going to China at a certain price. Many people have said, is it in any way threatening that the Gulf producers demand security into China? And people say, no, actually, it is displacing some US crude that would have gone to Asia. Would you say that's been the case?
Yes, because by the way, we broke the story on that. So we've been writing about this. We broke the story about 7 weeks ago about this. If you look at the data, you find the following. First of all, the mistake that the media made was not distinguishing between numbers and percentages. And I'm going to give an example so the audience will understand what's going on. The numbers I'm going to mention right now, I'm making them up just for simplicity. Let's say that China imports 10 million barrels a day, or let's say 5 million barrels a day, and 1 million from Saudi Arabia. As a number, it's 1 million. As a percentage, it's 20%. And let's say after the opening, China's demand jumps from 5 to 10. All the other 5 are coming from Russia, while the Saudi exports to China remain 1 million. So the number stayed the same. But now Chinese demand is 10 million. As a percentage, the Saudi share is only 10%. So the media focus on the percentages and saying, look, they lost market share. No, they did not. It's still the same million being exported. Now we've seen a decline in the number. But if you look at the number, for example, in India, in the first 5 months of the year, Saudi exports to India declined by only 100,000. That's it, which is the OPEC cut. And it wasn't competitive with because of the competition with the Russians. The same story for Iraq, etc. For Iraq, we've seen the most change simply because they were able to shift most of their oil to Europe. And to show you the bias in this case, we've seen all the headlines about the Saudis and OPEC losing market share in Asia, but no one mentioned that story as a headline that the US lost the most. You are not going to see a story that Russia lost its market share in Europe and OPEC gained the market share in Europe.
Yeah,
you can see how the stories are directed.
Okay, Dr. Anas, I'd like to get your point of view on, we move away a bit from figures and just to talk a little bit about another development since we last had you on this show, which is about the Saudi-Iranian rapprochement that has been happening in the region, behind the scenes, in front of the scene, if you like. Give us your take on that and whether you think this time, we have something really concrete, and what impact, if at all, is it going to have on energy markets?
First of all, the move is purely political, has nothing to do with energy, has nothing to do with oil. It has to do with everything going on in Yemen and Syria and other places and the threats to Saudi Arabia and others. There is a conviction there among analysts that the Saudis have those mega projects and they have 2023 vision and they really want to focus on it. And there is a lot of distraction coming from Yemen and the Iranians, and they really want to focus on their development. So that's the general view. But if you want to talk about energy and the oil market, Iran is producing at maximum, is exporting at maximum, and therefore, even if we end up with a new nuclear deal where the Biden administration signs a deal with the Iranians, with the blessing of all the neighboring countries, etc., Iran cannot increase production or exports immediately. It takes time to do that. At the same time, we have to remember the following, which this is a very important point for analysts to realize, that there are certain factions within the Iranian regime that became awfully rich of the sanctions. And it is not in their interest to normalize relations with the United States, with Europe, and with the neighboring countries, because all the money now will go to the government. It will go to the people. It's not going to go to them. And we've seen the evidence. Remember, there was 4 explosions that hit the 4 ships in Fujairah a couple of years ago. That one, Fujimori, basically was, I think, the Japanese prime minister. His plane was landing in Tehran airport. And 3 of the ships basically were related to Japan in one way or the other. It was very clear that there was a faction that do not want that meeting to happen. So as we go and move forward on this relationship between the Gulf states and Iran, let's remember that we might end up with some problems, that some factions within the Iranian regime do not want that approachment, and they don't want a resolution.
Okay, what about as we move forward with the changing relationship dynamic between the Gulf and particularly Saudi Arabia and the US, because that is increasingly, apparently, shifting with the Gulf becoming increasingly independent in its stance geopolitically, with China, with Russia, with its neighbors like Iran. Do you agree that there's been a shift?
Definitely there is a shift. It just expresses the idea that there is a new generation in the region that realized that they can really kind of stretch a little bit and the ceiling is way higher. They can raise their head. The retreat of the United States from the region, from the Trump years, basically allowed this on one side. So it's a two-sided story where you have the retreat of the United States on one side and the new generation on the other that really wanted kind of their own countries to be different and better. than before. So you have those two things coalesce together. At the same time, the new generation is completely kind of disenchanted with old ideas and with the US being the peace broker in the region, etc. So if you talk to people, basically, even if you look at social media, even people in the street, normal people on social media are really disenchanted with the United States approach to the region.
And of course, there was disappointment from the Gulf leaders here last year when there was some security concerns in the Gulf, and the United States was seen not to be stepping in and stepping up in that defense. Dr. Anas, before I let you go, we'll just reverse a bit back to the U.S. production question and give us your take on the outlook for that in general. Forget about whether it's exporting more to China or to Asia or not. But again, do you expect us to, everyone's saying we're not going to go back to 13 million barrels a day in the US ever. There are other priorities, there are other dynamics at play. Where do you see that going?
The possibility of getting to 13 million is there. The issue here is we really have to define what that production is, because really we have a serious problem, and I'm going to explain it quickly here. And I think I explained this in a previous program. We have a serious problem with the definition of crude when it comes to the EIA data, because there is a lot of condensates, a lot of NGLs that's being classified as crude in the EIA data. So to reach, based on the current definition, do we reach 13? Yes, based on the current definition. But how much of it is really real crude? So this is one part of the story. The other part of the story is, if you recall, when the Trump administration realized that they might lose the election, like a couple of days before they leave, and this was confirmed later, they give thousands of licenses or permits to the oil companies, federal land, because Biden was promising no drilling on federal land. Of course, that's changed later, and we ended up drilling more on federal land during Biden than Trump. But the idea here is those companies rushed to drill there after the recovery, and they found out that, especially on the western flank of the Permian, that this area is more gassy, which means that you are drilling for oil, and you have an oil permit, and you end up with a lot of gas and a lot of NGLs. That's a loss, because sometimes that gas is sold at negative price, and the NGL price relative to WTI is lower as a percentage, so they lose. So looking at the history of those companies since 2012, we found out that every time they go to a new area or a new zone, and they found out it's gassier, they retreat, and they go to the lower API, which is mostly 45 or lower API, the areas or zones. And this started recently. So we've seen all the increase after the recovery. Almost all the increase was condensates and NGLs in the production. And now we are seeing a reversal where companies are going to zones and areas with lower API. This is very important for the simple reason. If production is flat, no increase at all, as is. So you take the EIA definition and numbers as is, and people say, look, it's flat, it's bullish. No, it's bearish. Why? Because the percentage of crude in it is increasing. So we have literally increase in the production of crude by shifting from one region to another or from zone to another.
Okay, Dr. Anas, one more question for you, just on gas. We kind of touched on it when you were talking about substitution, and of course that was part of that trend since 2022, whether it was LNG being more in demand, less in demand versus coal, etc. Do you have an outlook for gas markets, gas prices for Europe, for example, and Asia? Last winter we had a bit of a panic over supply and a price spike, but that has since dissipated quite significantly. And most people are saying we're not going to see that again.
We publish a monthly outlook, and then we publish a report every week on natural gas with pivot toward Europe. So we cover that extensively. And our review basically is, yes, the storage is relative to the past, is really in good shape in terms of storage, but that means nothing. Because if you have a severe weather, all bets are off. And with the severe weather, the Europe is in deep trouble again this year and probably next year until they solve their problems. The problems are twofold here. One side is severe weather means higher demand. And if the severe weather is in China too, and in the Gulf of Mexico, I mean, the hurricane season just started in the Gulf of Mexico. And if we have a severe hurricane season, all U.S. exports of LNG that goes to Europe goes from the Gulf of Mexico. So if we don't have regular shipments, while China basically is suffering from a heat wave and they are fighting for every molecule out there, well, what we are going to see? We are going to see Europe basically resorting to more coal, literally, to generate enough electricity to keep things cool in the summer. And therefore, they cannot build the storage enough to get ready for the winter. So we are still expecting a problem in Europe if the weather is severe in the summer and winter. And if it's a globally severe weather, then they are literally in crisis.
In the hands of the gods, though, there's nothing we can do about that. But Europe has done a good job of calibrating its gas infrastructure, certainly since the Russia-Ukraine war started. It has been commended with that. Dr. Anas Al-Hajji, Managing Partner at Energy Outlook Advisors, thanks so much for joining us today.
You're welcome.
On Halftime Talk. It's been great to have your views.